Joining me now is Trey Reik, managing member of Bristol Gold Group. Thanks for being with us, Trey.
Thanks for having me.
Now, with gold, it held up pretty well last year, as you know, and even did quite well in non-US dollar terms. And since November, we know that gold and gold-related stocks have done quite well. There are a number of macro factors for that, some of which you'll get into. But do you think the main reason right now is the fact that the US dollar has been weaker, and you've also got long-term bond market players seemingly sniffing out disinflation, decelerating economic growth, and the possibility perhaps of a profit recession as well? Is that sort of the main thing driving gold right now, do you think?
Well, you covered a lot in that list of things, but my first response would be that I think you're giving gold markets a little too much credit if you assume that gold's stronger performance since November is connected to things like global bond movements and disinflation and GDP and profits and that type of thing. Our view is that especially during 2022, with the Fed raising rates 425 basis points, and the connected impact on the dollar, with DXY index was up 21%, and two-year yields were up tenfold from 47 to 470 bips. While all of those are important to gold, they were all such steep moves and so rapid that I think the short-term trading on gold really, took center stage. So my point is that rates were going up so fast, and the dollar was appreciating so rapidly that I think that really dominated trading of gold during the year. And now with the Fed just, the whole world has become so Fed-centric. That's sort of one of our complaints with asset markets these days. Everything has become an extension of the Fed. Everything has become an extension of liquidity, and we're either adding liquidity or not, and that's really the only variable that matters. So for lots of markets, including gold. But now we have the Fed seemingly, even though they're still huffing and puffing and raising rates at a slower rate and talking about staying at 5.25 for a year and still proceeding with QT, just the hint that they may be getting close to a pause or a pivot has gold up $300 from November lows, and we haven't even stopped hiking yet. So our view is it's really just a reflexive movement from the Fed's very vertiginous slope of rate hikes. And now that we're nearing the end of that, gold is starting to respond. We've always said gold has a tendency to do well, not necessarily when the Fed actually pivots or pauses. If you look at the past cycles, the Greenspan cycle in 2004, 2006, and the Yellen cycle, which started in December of 2015, gold has a tendency to do very well over the cycle, and it starts to outperform, we would say, when not necessarily when the markets expect the Fed to change direction, but when markets start to become concerned that the tightening is causing something to stretch or break, et cetera. And we think, that is another reason why in November, as housing markets and automobile markets and stay-at-home meme stocks and things like Carvana and Peloton, fell 95%, we're sort of starting this process of rationalizing the malinvestment from 15 years of QE and ZIRP. And that's going to be, in our opinion, a very ugly rationalization process, and it's in its early stages. But we would suggest the gold price is more related to recognition of the fact, that financial asset prices are probably due for a pretty tough stretch next year.
Well, let's stick with the Fed. I wrote an article a while ago that had what I thought was a kind of a provocative title, but that the Fed pivot is a BS narrative. Do you think that Jay Powell, he really wants to make up for the mistake he made in letting inflation out of the box, and he also wants to be kind of a mini-me Paul Volcker and stick with tight rates and even keeping them high and pausing for a long time until he finally tames inflation. And do you believe that barring a calamitous event, barring a big credit event or something like that, that the Fed pivot is not coming and investors should stop waiting for it?
Yeah. So I think mentioning Paul Volcker and Jerome Powell in the same sentence or paragraph or even page is probably a bit blasphemous in the sense that you mentioned, you were starting to talk about it briefly, but the Powell Fed is in my opinion, what they did in 2021 with QE and ZIRP, keeping 120 billion of monthly QE going when we had 6% GDP, 7% GDP, and 6-7% CPI, and unemployment had already fallen from 15 to under 5. But that 120 billion per month of QE throughout 21 and the later part of 2020, mixed with keeping rates at zero, is going to go down as one of the biggest policy mistakes of all time for the Fed. And I think now they're cementing their legacy as the most mistake-prone Fed of all time, thinking that they can simply correct their errors by taking rates up as fast as they have. So, with this, when the Yellen Fed started its tightening cycle, total credit market debt in the U.S. was about 62 trillion. That was in December of 15. Today, it's 92 trillion. So we're up about 50% in every category of debt that matters in the United States. And the Fed's balance sheet, which was about 4.5 trillion when the Yellen Fed started its tightening cycle, is now famously at 9 trillion. And yet the Fed is attempting, when the Janet cycle started, they raised rates 225 basis points in 36 months. And at the end of that, as you recall, we had to have the first Powell pivot, and we had the repo crisis, and we had to undo a lot of that QT in 4 months. And then that bled into the COVID situation, and we've really been queuing it ever since. But anyway, the point is that the Yellen Fed did 225 basis points in 36 months. The Powell Fed has just pushed through 425 basis points in 9 months. So we've pushed through a rate increase 190% of the prior cycle in 25% of the time, with total debt up 50% and the Fed's balance sheet up 100%. So I don't think any of this is going to be in Chair Powell's control. I think that we're set up for realization throughout 2023 of this massive amount of malinvestment that has been fostered by this decade and a half of ZIRP and QE. So I'm pretty certain that financial markets are in for much rougher time than is commonly accepted at this moment in time. And I think the Fed is going to be responding rather than, inflicting its will.
Trey, specifically with gold companies, you've noted that in the last several years, many of them, especially the bigger ones, they've become much more disciplined with their capital. They're not making ill-timed deals. They're not piling on tons of debt. So if we are in the midst of a multi-year secular bull run for gold, what kind of performance could we see for the Barricks of the world and the Francos and mid-tiers and others if gold has a meaningful run above 2000?
Right. So one other thing I think that's interesting to keep in mind, gold, as we all know, gets fairly denigrated for never doing what everybody wants it to do. It's one of the only things I've ever invested in that the current price is never the right price, that people think it should be going up faster or higher or doing something different all the time. Gold first traded at 1,800 about 2.5 years ago. And the irony is that intervening 2.5 years, 90% of the trading has been within $100 range, above or below 1,800, with minor flares up to the 2,070 level and down to the 1,625 level. So things have been remarkably stable in terms of the trading range for gold. In that time, I think a lot of the better run companies have finished this sort of decade of upping their attention to capital discipline and management execution and dividend policies and all that type of thing. So they're in really good shape. Not to mention the fact that I always believe gold companies are about a decade ahead of general markets in ESG, because they've been focused on those types of issues, for a long time. So I think gold companies are, incredibly well managed and, up to date on all that capital discipline type stuff. So unfortunately, we've had this inflationary period from 2021 and 22. So obviously that's impacted miners, and we have a tendency to focus on miners who are building new mines, because we believe that's one of the true opportunities for value creation in the gold mining chain. But to answer your question, with all-in costs, now around $1,600 for the entire industry, and including some of the less well-run companies, and gold at 1,800 and 1,825, say, that's a cash margin per ounce of $225, and a $500 move in the gold price, which I think is, well, first of all, this year we already have $100 in the bag. So assuming we do another 400 or so this year, which I think is pretty easy, especially given the stored force of the past trading range of the 2.5 years, and we get gold up to 2,500, that would triple that cash margin per ounce from 225 to something like 750. So I think people forget that, especially with the high fixed costs and the inflation, et cetera, that's been in the industry, a $500 move in the gold price, will triple cash margin profitability at the entire industry, including the companies that aren't as well run as some of the really well run ones. So in terms of percentages, it's always tough, to predict. But let's just say I would think that gold's percentage move, and a move from say 18 and a quarter to up $500 is about 27%, which is nice. But I think that you'd see multiples, 3-4 times that in percentage moves in well-run gold miners.
Lastly, Trey, in a secular bull market for gold that could last several years, should investors be positioned in the physical metal, in companies, in ETFs, a combination of all three? And also, lastly, second part of that would be, are there any names? I don't know if you throw out names every now and then as a stock picker, but any names we should be paying attention to?
I think especially on the individual or endowment level, as opposed to a large institution, I think it's extremely important for investors to get their gold allocation squared away first. So if there's someone is interested in making a 5% commitment to gold, I personally believe, maybe 70 or 80% of that would be best allocated to a gold equivalent, because gold accomplishes what it does and is therefore, in terms of the store of value, et cetera, best, when it's bullion. And then for some smaller portion of the total, maybe, a fifth to a half, I think investing in high quality miners makes a lot of sense. I personally would steer people away from things like the GDX and the GDXJ, because without naming specific names, they're, say, in the top 10 holders, they're miners which for various reasons are challenged in their geographies, et cetera. And I refer to it as a negative survivorship bias. So there's not a lot of industries around where the largest companies have, they usually have a positive survivorship bias. But in the gold mining industry, because these large companies have to replace their reserves, which is so difficult, especially in the current environment, there's sort of a negative survivorship bias in what those companies are up against. So only the very best run companies can get over that hurdle. So anyway, I would focus, instead of on a broad ETF of gold miners, on a portfolio of, say, 6 to 8 names minimum of very well run companies. And on the gold side, as an example, I'd pick Agnico, which is as well run as any company in any industry of which I'm aware. And on the silver side, I might pick Pan American, and company like Barrick, which is also very well managed. So I would stick with a select group of well managed miners as opposed to the broad ETFs.
Great stuff, Trey. We got 3 names from you. We appreciate your time, and we'll see you again.
Terrific. Thank you very much.
All right, Trey Reik. He is managing member at Bristol Gold Group.